Your startup is off the ground. Piggy box money is finished, and now it's time to search for seed investments. You have probably already prepared your pitch deck. You have the right financials, you know where you are and where you will be in 1 to 5 years. You have a solid complementary team and a business plan. You understand your valuation and are able to defend it with industry specific benchmarks. You have a strong value proposition. You know your customer acquisition costs and lifetime values. You can explain how your product will evolve and how the exact roadmap ahead looks like. Finally, your team is perfectly aligned also on the exit strategy. You weighed the benefits of IPO versus sale, and you can defend your position to the potential investor. Great job. You think you're ready, but you might not. Why so? Well, what about your IP? Are your IP rights properly integrated into your business plan? And are they duly protected? Because if not, you are in big trouble. And that angel or VC you've been circling around for months might very well slap the door in your face. Very simply put, investors care about your IP because proper IP strategy results in better return on investment and lower risks for them. Let's briefly go over it, shall we? There are two sides to IP rights. On one hand, IP rights are key economic assets that can be further leveraged for a company's growth. This means that having IP duly protected will have a tangible economic impact on your startup. How can a company derive value from an IP asset? Well, this can be done in three different ways. All of them are appealing to investors. First of all, through direct exploitation. You use it and prohibit others from doing that. As simple as this. Second, through selling and licensing the IP. Read cash flow. And number three, the indirect value, derived from IP that results in your startup being able to offset supplier power, mitigate industry rivalry, minimize the negotiating power of customers, reduce the threat of substitutes, and raise barriers to entry by competitors. Read Porter's 5 Forces. Investors care about the economic value of your company's IP assets because the bigger the value, the more return on investment they realize. On the other hand, properly handled IP rights enable risk mitigation. Think about it this way. If your trademark is not registered, someone else can do that in your place and then prevent you from using your own brand. Imagine all that marketing budget going right down the drain. Or worse, did you know that copyright in that software which your startup intends to commercialize by default belongs to the freelance software developer who did that for you? Were these rights properly assigned to the startup? What about the IP provisions in your contracts? Or if one of your team members walks away tomorrow, would that mean bye-bye to all of your trade secrets? From an investor's point of view, no solid exit strategy could be imaginable without considering the IP strategy. And you know by now, no exit strategy means no investment money. This means that a diligent assessment of what rights might be relevant for a startup, as well as in which scope and at what stage they need to be protected, is vital for making your startup a big success. It certainly deserves to be. The bottom line is that a proper IP strategy should be regarded as your valuable investment into your startup, and not as something you will think about later on. So tell me, is your trademark registered? Is your technology patented? Is the copyright assigned? What is the risk that your startup will be sued for IP violations by someone else? And now that you know that a solid IP strategy will get you closer to securing seed funding, don't you want to act? Reach out to us and we will send you the investment readiness checklist from the IP perspective to ensure that there are no deal-breaking surprises during your pitch. Let us help you make sense of your IP.